welcome all of you to another session of Navigate with HSBC, where we take you through the nuances of investment and enable you to take the right decisions when planning for your future. We are very happy to share with you that this evening we have with us Shyamal. Shyamal is the Managing Director and Chief Investment Officer for RV Capital, who are a very large private credit player globally and now in India. Shyamal, thank you for giving time to us for this session.
Thank you for having me and lovely to be here.
Shyamal, as an investor, how do I choose from so many credit funds that are available in the marketplace? Should I look at the credit fund manager also as one of the things that to review when I'm looking at a credit fund?
I think that's the most important thing you should look at because ultimately manager defines the fund. The manager is not good, the fund is no good, right? I mean, ultimately the manager. I think the few things which are part of the litmus test that we believe any investor should look at. Of course, the fund, the manager's track record, how it has done with other funds in the past, the team's track record, the team's experience. As I said, like, very important that team has seen the cycles in the past and not just like somebody who's been in the market for 5 years and has seen only a bull run, right? It is never a bull run. I mean, things don't remain constant. So that's the second thing. I think the third most important thing, we are finding more and more in India, is the absence of conflict of interest. Because many groups or many situations where we find that within the same setup there could be multiple verticals. It could be wealth and investment banking, NBFC, fund. Now, it is very important to have very strong Chinese walls and the policies that there is no conflict of interest. If those systems have to be in place, ideally, probably find somebody who is a focused asset manager rather than having a multiple vertical. Because what happens is that from the point of view of when you look at a deal, whether a deal should be done or not done, it should not be defined by the multiple verticals of the group, but only by what the fund requires and what the fund's mandate is. So that's the very important factor for us. And most important, the team has to be fully invested, literally and financially, in the fund. So that is what shows the alignment of interest. So I think these are some of the requirements of a good fund manager. Of course, some of the things we talked about earlier in terms of having systems and processes, platform support, etc., etc. Those things are of course very, very important. But ultimately, these are the factors, right?
A bit earlier, when you're talking about private credit as an idea, investing idea, you also mentioned about asset allocation. You talked about overall risk profile of customers. So tell us a bit about HNIs. Who we know are people who've already generated a significant amount of wealth, are really looking at preserving rather than necessarily doubling their wealth over a period of time. What would your advice be in terms of asset allocation? What percentage of assets should really go into a private credit kind of a fund?
So we have a very interesting thumb rule internally which we use. We believe that the percentage of allocation of an individual investor in fixed income should be the percentage of his age. So if an investor is 40 years old, his allocation to fixed income should be 40%. And as the age grows, the percentage keeps going up. So that's one thumb rule which you use, and surprisingly, it seems to work in every scenario, really. Because as you're young, of course, you don't need to invest too much, and as you grow old, obviously, you need to preserve your wealth because you already made your wealth, right? And this actually is supported by the global. If you look at the global data of HNIs and ultra HNIs, like we were just looking at this Capgemini report of the HNI allocation. I was very surprised to find that the equity allocation on average for this segment globally was 25%, and fixed income allocation was more than 50%. Alternates was 15 to 20%. Now, if you compare it with India, the alternates in India is less than 5%. Equity is definitely more than 50% in most of the cases. I mean, I would not say all, but most of the cases more than 50%. Now, of course, equities have been doing very well, and I mean, obviously, we hope and that will continue to do well. But as we have seen over the long period of time, there has to be some amount of reallocation and sensible and wealth preservation which has to bring in. So it is important to really rationalize that a bit. So our view, as I said, like age percentage should be the fixed income, and alternative assets has to become a bigger part of the overall allocation of fixed income, especially the private credit fund is a part of fixed income, because as we discussed, the alpha is significantly higher, almost 4-5%, double of what you actually get there in a liquid fund.
Private markets or alternate investments have a place, And within that, I think performing credit or any other form of credit fund must find some place to ensure that the customer has a more holistic portfolio. Where does RV Capital really stand on the framework that you just spoke about?
As I said, like RV Capital, we are a fixed income focused asset manager. Our strong belief is that it is possible to generate a better quality return similar to equities or on a lower risk adjusted basis. So that's the basic philosophy. So all our three strategies, whether it's the macro strategy across Asia or the Asia liquid credit strategy or the India credit strategy, all of these strategies generate returns which are more than what equity returns are generated. So philosophy wise, we believe that when you devise a private credit strategy, firstly you have to devise that what you will not do. So first you make a list of what I will not do. So we were very clear on what we will not do. So we looked at our experience, the team's experience over the years, which are the segments where it is the most challenging to generate returns or where there's the most highest probability of getting into accidents. So we fund, for example, is a performing credit fund because that's where we should start, because ideally you should not expose the investors immediately to the high risk strategy, especially if it's family offices and HNIs. If it's an institutional investor, they have the sophistication required to really understand that risk. But if you're talking about family offices and HNIs, which are the largest segments of the investors in India, we don't want to expose them to high risk. So performing credit, number one. We don't do real estate in this particular fund. We don't do venture debt because we believe that the risk returns are quite skewed. They're not balanced, right? Risk and return. And most of all, we don't do deals in companies where there is a restructuring history in the past and the management has not changed. The same management which is responsible for banks losing money, we don't want to lend to those companies. So this is a negative list for us. Having said a negative list, then positive, from the positive side, from the side of what we want to do, as I said, that the risk mitigants, the biggest risk mitigants are essentially for us the management quality, the collateral quality, the monitoring, the due diligence, etc. So we have set up systems in place here. We have a team in India, we have a team in Singapore, London, Dubai, etc. So we have existing processes in place, the team in place. Really, we want to build this business because we believe this segment is going to be very big going forward, just like it's going big globally. Because there's clearly a gap from both from the investor's perspective as well as from the borrower's perspective.
I think no discussion, Shyamal, can get over unless we talk a bit about India. And before we came to speak to on the stage, you and I were talking about what's happening in India, and I was asking about interest rate. I think we'll ask this question here. Tell us a bit about what's happening in India on the macroeconomic side, especially given the private credit perspective. How do you see that growing in India? What opportunities are coming up? How do you see rates happening? So many things happening. So tell us a bit about that perspective.
So I think India has been in a Goldilocks zone. We all agree. I mean, last 3-4 years have been one of the best I've seen post-COVID. GDP is going up, inflation is coming down, fiscal deficit coming down. Nothing could go wrong, right? I mean, that has been the trademark, and currency was stable. Obviously, India, and like any other country, is not an isolated island, right? There are global factors at play, and we just saw that last night, on the FOMC, the Fed meeting. They cut 25 basis points, but there was a hawkish cut. So suddenly the market is kind of sold off a bit. I think these kind of things also we need to keep in mind. And some of the recent data on the trade deficit, etc., and the GDP, etc., has been a little bit weaker. But having said that, our belief is that fundamentally India's economy has changed. Indian economy is not the same it was earlier. And even if there's a problem, global factors, etc., it is robust enough to bounce back very easily. We still believe that the GDP growth rate in the current year will be in the range of 6.5%. Next year, probably be a little higher than that, 6.7, 6.8%. CPI, there was a scare, the CPI came high, but with the vegetable prices coming down, the CPI inflation, we expect it to moderate, come to around 4.8, 4.7 level by end of the year and 4.5 next year. So we are okay. I think macro-wise, we are quite all right. And nothing to worry about. I think we continue with I think government is continuing with the liberalization process, etc., which is going on. In terms of your question regarding what is the correlation with the private credit, I think it is actually a pretty strong correlation, which many people don't realize. One of the reasons why the private credit market has grown is because the GDP has driven a lot of capacity creation, M&A activities. If you remember, maybe 10 years back, there was hardly anything happening. There was no M&A, there was no capacity. People are scared to put up capacities. Today, people are happy. Everybody is expanding. Everybody putting up fresh startups are happening. Startups are also capacity creation in a way, right? Though we don't do that, but I'm sure, from the economics perspective, that's a great thing. So that capacity creation will continue, and that will kind of continue to drive the, private credit. Of course, obviously a little bit of moderation just as we expect the equity returns to moderate, we also expect the growth in the capacity creation to moderate a bit, but it is not significant. We will continue to see a growth of this segment, and even with the same capacity creation and M&A activity, we believe the percentage of private credit as an overall credit basket is going to grow, because more and more are going to move towards this segment of the market because of obvious reasons we discussed earlier.
Shyamal, this is a very engaging conversation. I think we covered an entire range of topics, from what private credits are, how has regulations enabled private credit, how is the thriving market in India, how should investors choose from products, and of course, macroeconomic and I think the overall buoyancy of the Indian economy. Thank you for your time. It would not have been possible without you being here and talking to us in these details. Really appreciate, and we obviously look forward to hosting you again soon in one more session. Thank you for joining us for yet another episode of Navigate with HSBC. Please follow us on all social media platforms at HSBC India. Also log on to our website in the description below. Thank you.